You are sick, not dramatically sick, just sick enough that you know something is wrong. There is a pain in your chest that wasn't there last week, and it hasn't gone away, and now it's Tuesday, and you're standing in your kitchen in 1922 wondering what to do about it. You don't call a doctor, not yet. Calling a doctor costs money, not insurance money, not a copay. Real money out of your hand into his at the door. $1.50 for a house call. $2 if it's serious. And you make $9 a week at the mill. And the rent is due Friday. And you have 3 children. And so you wait. You wait a week. The pain gets worse. You tell your wife it's probably nothing. She knows you're lying. You know you're lying. But the arithmetic doesn't change. And so you wait another week. This was not a rare situation in 1922. This was the normal situation. For the first 150 years of American medicine, there was no system standing between you and financial ruin when your body broke down. No insurance card, no network, no deductible. You'd already met. Just you and the doctor and whatever cash you could scrape together, and if you couldn't scrape it together, you went without. And sometimes that was fine, and sometimes that killed you. So the question isn't just historical. It cuts right to the bone. How did ordinary Americans pay for medical care before health insurance existed? Who finally decided to change it? And why did the solution that emerged come not from the government, not from a reform movement, but from a hospital administrator in Dallas, Texas, who was worried about his empty beds? Because this isn't just a story about insurance. It's a story about what happens when medicine becomes expensive faster than ordinary people can afford it. And about how the system that was built to solve that problem in 1929 ended up creating problems of its own that we are still paying for today. Let me put you in a different kitchen. Not 1922. Earlier. It is 1880. You are a farmer in rural Indiana. You are 44 years old. Last month you broke 2 ribs coming off a wagon. The doctor came out from town, bound your chest, told you to rest, charged you 50 cents, and left. 50 cents. You had it. Crisis managed. This was how medicine worked for most of American history, and for most of that time it worked well enough, because medicine was cheap. Not because doctors were generous, because medicine couldn't do very much. There were no x-rays, no antibiotics, no surgical theaters with anesthesia and sterile fields. A doctor in 1880 arrived at your farmhouse with a black bag containing some instruments, some compounds of uncertain efficacy, and a reasonable bedside manner. He charged you what you could afford to pay because there wasn't much else to charge for. The problem began when medicine actually started working. Between 1880 and 1920, American medicine underwent a transformation so rapid and so complete that it barely resembles what came before. Germ theory replaced miasma. Antisepsis made surgery survivable. X-rays allowed doctors to see inside living bodies for the first time. Anesthesia transformed operations from agonizing last resorts into routine procedures. Laboratories appeared. Diagnostic tools multiplied. And hospitals, which had been places where the poor went to die, began to be places where the sick went to get better. All of this was extraordinary. All of it cost money. Not 50 cents. Not $1.50. Real money. The kind of money that built buildings and bought equipment and trained specialists and paid nurses and kept operating theaters sterile and stocked and ready. By 1920, a serious illness in America could cost a working family everything they had. A week in the hospital ran $40 to $60 at a time when the average industrial worker earned $25 a week. Surgery could run into hundreds. A prolonged illness, pneumonia stretching into weeks, a difficult childbirth, a broken bone requiring orthopedic care could wipe out years of savings in a month, and there was nothing to catch you when you fell. No government program. No employer plan. Private insurance companies in the 1920s sold accident and disability policies, which paid you a small income if you couldn't work, but they didn't cover medical bills. The distinction mattered enormously. You might get $12 a week while you were laid up. You would still owe the hospital $40 a day. The people who studied this problem, and by the 1920s, a serious group of economists and physicians were studying it very carefully, concluded that the cost of medical care had become what one report called an unpredictable catastrophe for ordinary Americans, not a predictable expense you could budget for. An unpredictable catastrophe. You couldn't know when it was coming, you couldn't know how much it would cost, and by the time you found out, it was too late to prepare. The Committee on the Costs of Medical Care, which was commissioned in 1927 and spent 5 years studying exactly this problem, released its report in 1932. Its findings were blunt. The costs of medical care are borne by individuals in amounts that are both irregular and unpredictable. Families of modest means who encounter serious illness face financial disaster. The committee recommended group payment for medical services, spreading the risk across large populations so that no single family bore the full weight of medical catastrophe alone. The American Medical Association called the report socialist propaganda and buried it. But the problem didn't go away. It got worse. Because 1932 was also the worst year of the Great Depression, and hospitals across America were running out of money. This is where the story gets strange. Because the solution to the American healthcare financing crisis didn't come from Congress. It didn't come from a reform movement or a presidential commission. It came from a mild-mannered former schoolteacher named Justin Ford Kimball, who had recently become the administrator of Baylor University Hospital in Dallas, Texas, and who was staring at a very specific problem in a very specific ledger. Kimball's problem was simple. Baylor University Hospital was owed a lot of money by people who couldn't pay it, teachers mostly. Dallas school teachers who had come to Baylor for care and left owing bills they had no way of clearing. The average unpaid teacher debt at Baylor was around $9, which doesn't sound like much until you multiply it by hundreds of accounts and realize the hospital is slowly bleeding out. Kimball had an idea. What if the teachers paid in advance? Not when they were sick, before they were sick. A small amount every month spread across the entire school district so that the cost of any individual teacher's hospitalization was absorbed by the collective. The sick teacher's bill would be covered by the healthy teacher's monthly contributions. The hospital would have a predictable revenue stream. The teachers would have protection against a bill they couldn't afford. He worked out the math. 1,250. Dallas school teachers. 50 cents a month each. In return, each teacher would receive up to 21 days of hospital care at Baylor, fully covered, per year. 50 cents a month. For a guarantee that no medical bill would destroy you. He presented the plan to the Dallas teachers in the fall of 1929. Over 1,200 of them signed up within weeks. The Baylor Plan, as it came to be called, was not the first prepayment scheme in American history. Railroads and mining companies had been running something similar for their workers for decades, deducting small amounts from wages to pay company doctors. But those plans were employer-controlled and doctor-supplied, and they existed to keep workers on the job, not to protect families from catastrophe. What Kimball built was different. It was voluntary. It was community-based. And it was organized around the hospital rather than the employer, which meant it could, in theory, be extended to anyone willing to pay the monthly premium. Other hospitals watched what Baylor did. Then they started doing it themselves. By the mid-1930s, Hospitals across the country had launched their own prepayment plans. The plans proliferated faster than they could be coordinated. Different plans, different hospitals, different rates, different rules. A teacher in Dallas had coverage at Baylor. A teacher in Houston had coverage at a different hospital. Move between cities and your plan meant nothing. The American Hospital Association saw the problem and saw an opportunity. In 1937, it established a set of standards for nonprofit hospital prepayment plans and began approving them under a common symbol that would come to be recognized everywhere: a Blue Cross. Blue Cross was not a government program. It was not an insurance company in the traditional sense. It was a network of nonprofit hospital-based prepayment plans coordinated by a hospital trade association, designed to guarantee hospitals a steady revenue stream while giving subscribers protection from the cost of hospitalization. It spread with remarkable speed. By 1940, 6 million Americans were enrolled in Blue Cross plans. By 1945, that number had climbed to 19 million. By 1950, it was nearly 40 million. And then the Second World War did something nobody planned for. When the federal government imposed wage controls in 1942 to prevent wartime inflation, employers found themselves unable to compete for workers by offering higher salaries. So they competed in other ways. Benefits became the currency of the labor market. Pension plans, vacation time, and health insurance. The War Labor Board ruled in 1943 that employer-provided health benefits were exempt from the wage freeze. That ruling, combined with a 1954 tax code decision that made employer health insurance premiums tax-deductible, created an incentive structure that would define American health care for the next 80 years. Employers bought health insurance for their workers. Workers came to expect it. The system calcified. By 1960, the majority of working Americans had employer-provided health coverage. The minority who didn't, the elderly, the self-employed, the poor, the unemployed, the part-time, went without. The gaps in the system became crises of their own, and the attempts to fill those gaps became the political battles that defined the next 60 years. Medicare in 1965, Medicaid alongside it. The failed Clinton plan in 1993, the Affordable Care Act in 2010, each one an attempt to close holes that the 1929 architecture had left open. Because here is what Kimball's 50-cent plan could not have known and could not have prevented. When you organize a health system around employment, you build into it a mechanism for exclusion. The people who need coverage most are often the people least able to get it through work. The sick, the old, the poor, the part-time. The Dallas teachers who signed up in 1929 were lucky. They had steady jobs, an organized district, and an administrator who had done the math. The man with chest pain in his kitchen in 1922 had none of those things. His name in this story could have been anyone. It still could be. Whether the system that grew from that Dallas schoolroom in 1929 was better or worse than what came before depends on what you value. It covered more people than ever before in American history. It also left millions uncovered in ways that were, by design, almost impossible to fix from inside the architecture. Understanding how that architecture was built and why and who it was originally designed to serve, that's not just history. It's the blueprint you're still living in. If this story changed how you read the back of your insurance card, make sure to subscribe and drop a like. We go deep on the hidden machinery behind the systems that shape your life, the ones most people never question. There's another story coming that you will not want to miss. Thanks for watching, and I'll see you in the next one.